and 72% of the time the market goes up. And the answer came to me. And that's when I developed my chart. The answer came to me is because, just like Caterpillar, when they pull their money out, you get out. Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
Bye. And welcome to my podcast. Hi, I'm Phil Grande, philsgang.com. Okay, lots to discuss today. What happened between Wednesday night and today? Well, I have that for you, and I'm going to explain it to you. All right, first, though, let's play the cut where they said the economy was sizzling.
What do you make of all these numbers? You do this every day.
It's you started off talking about a temperature check. I say sizzling. That's the temperature, sizzling.
Sizzling. Really? Then how come Walmart tanked? Boy, I guess it did, didn't it? Why? Because the consumer, he's not strong. So how can they say the economy's sizzling? That's ridiculous. And they didn't have good guidance going forward. So to say the economy is sizzling is just unbelievable. It's not. Walmart, I think, is one of the things you look at to find the truth. Also, we look at yields to find the truth in the market. The yields tell us the truth. IWM confirms the truth. Now, today's rally is being driven by what? Not truth, but what happened yesterday on the institutions. Now remember, there's 12 institutions. They have about $35 trillion, and they fuel the stock market. And on Wednesday night, when we were ready to go ahead and wait for the earnings, we were all excited about NVIDIA, and everybody thought that they would come out with a gangbusters number. Now, nobody cares about the number, the earnings. That's in the rearview mirror. They want a gangbuster forward-looking, okay, where they say, wow, going forward, we're going to be really good. Well, that wasn't the case. Disappointed. So that's when the institutions started to panic. So when all of a sudden they said that looking forward, okay, NVIDIA, they were really skeptical. The yields that dropped the day before because the big institutions were worried something was going to happen like that. They were anticipating, so they bought all kinds of bonds, okay, out of fear, okay, to drop, and that will drop again your yields. Remember, lower yields is what moves these tech stocks. So when NVIDIA didn't have good forward-looking report, they came in, the institutions bought a bunch of bonds, and yields went down. And then the next morning, with the disappointment, everybody thought the market was going to go take off 1,200 points at least, right? Of course, it didn't. So what happened the next morning is yields went back up. So first they were down, okay, on Wednesday night, disappointed. Wake up in the morning, yields are all the way back up again. That's a killer. So as the market kept trading, the institutions got even more worried, and they decided, you know what, we got to go in here and we got to buy these bonds. We're looking for safety now, the institutions. Now remember, when they're looking for safety, there's only a few places they can go to park their money. First of all, they go to the bond market, and that's what happened, and that's why, again, the night before we had a low yield, next morning we had a high yield, and they bought bonds again, and now we're down to a low yield again. But the other place they park money is in a handful of AI stocks that are big enough, they're so liquid, that they can make orders, do a $500 million buy order, buy another $300 million, and the stock hardly moves. So they can do that, okay, with a few stocks. In fact, if you look at which stocks they do that with, it's mostly mostly the makers of the machines, okay, for the chips. And those are big enough to put money in so that the stock doesn't go wild. So again, we had, that's exactly what happened. So if you look at the chip machine makers, AMAT, CLAC, ASML, LRCX, those are big enough, have so much liquid, they can do a $300 million order, $500 million, I'm going to buy 300 million shares, 500 million shares, and the stock hardly moves. If you did that with Starbucks or somebody else, you'd be screwed. Starbucks would go up 2,000% and the market would be all screwed up. So what they did is yesterday when they got nervous, they bought more bonds and then they parked a bunch of money into those 4 stocks. But they also parked money into some ETFs that are very defensive, like healthcare. They take about 5 of those and they spread their money out. That's what they did yesterday. So this morning, all the jibber jabbers on TV are saying, well, look at the market, it's going back up again, things are terrific, nobody cares about high yields anymore because the demand is so terrific. Well, that's not true. So we got to be very, very careful now, and I've been through this before. Remember, there's a right reason for yields to go down and a wrong reason for yields to go down. And when the wrong reason they push yields down, it's very dangerous. And the wrong reasons are when the bankers or the consumers are really in tough shape, like now. The banks, okay, they're in bad shape right now. Credit spreads are tightening, and we got recession signals rising everywhere. So when they buy bonds and push yields down, they push stocks up, but the yields are going down because they're buying and going down for the wrong reasons, that's not good. That puts you on a tightrope. So every day that we trade from here on in, we don't stop trading, but we got to make sure we keep our eye on that bond market, because we went down, this bond market, these yields went down for the wrong reasons, and that's why today the stocks are up. And so again, anytime they buy these bonds for the wrong reasons, that's not good. The right reasons for yields to drop when they buy bonds, the right reason is always that, one, inflation is cooling. Well, we know inflation is not cooling. We just got that terrible CPI and PPI. The other thing that is the right reason for yields to drop, okay, is the big thing they look at is shelter. Well, shelter, housing, are you kidding me? That's not going down. And wages slowing. That's not happening. Wages are going up because you can't get people to work, so they pay people more. If a job's $50 an hour, they'll pay them $30 an hour just to get them. So the right reasons for yields to drop, inflation cooling, oil under $90, housing costs dropping, wages slowing, that didn't happen. So our yields went down for the wrong reasons. Now, what they would, by parking the money in these 4 big tech stocks that build these machines to make chips, everybody started to see those stocks going up this morning, so everybody starts jumping in with the noise coming from the TV jibber jabbers. Everything's okay again here. Just look at the yields, they're down. That's telling you everything's fine again. Well, they don't tell you the truth. They're down for the wrong reasons. So that's what's going on there. And so the whole stock market is always driven, remember, by these institutions. These are powerful institutions. And these, think about it. $31 trillion they have in money to move around in the market. And so, so when they could buy bonds yesterday to push those yields down, and everybody starts trading, I'm saying I'm not telling you do not trade. I just told my gang members a few minutes ago, I said, we know that the market's rallying today on the wrong reason. Yields went down, but for the wrong reason. But that doesn't mean we stop trading. We trade smartly. We make sure we put stops in, we get some good rallies, we sell into the rallies, and we just be cautious, and we continue to watch the yields over every day to make sure we don't get trapped. This is where a lot of people do get trapped, Now, how long this can last, we don't know. I've been through this where sometimes it lasts for 2 days, 3 days, and all of a sudden the yields shoot right back up into the kill zone. Remember, we've been in the kill zone. And yesterday at 450 or higher, that's the kill zone. That's the yields. That's the bond market telling you we're heading for a recession or we're heading for a correction. It tells the truth. IWM will turn around and confirm it when it turns red. It turned red yesterday. But what happened is, again, we get more false confidence today because when the big institutions bought all the bonds yesterday to push the yields down, well, IWM, the small mid-cap stocks, they shot up because they like low yields. So in the morning, they're in the red, telling us, look, the bond market, the yields are telling us they don't like the stock market. It's dangerous here. And they turned red, confirming. But when the bonds were bought by the institutions, that all fell apart, and all of a sudden IWM goes up through the roof, the small mid-cap stocks. So that's why you got to be, very, very careful. And the other thing that people don't realize too is that the banks are rallying, but they're rallying for the wrong reasons. Okay, again, big institutions will park money into banks because they're stable. So people are jumping in now buying bank stocks, which they're out of their minds. Now, if you're just doing some couple-day trades, something like that, you're not buying the whole. Sure, you can trade, do some, swing trades, do some position trading. We've been doing swing trades with the banks for a couple weeks now. So, what's going on with the banks is the yield curve is telling us that these banks are in bad shape, but the stocks are going up. So you have to take a look at the yield. It tells you the truth. So the ideal, okay, when the bank's profitable and really doing well, okay, the yield curve is at 150. Well, right now the yield curve's minus 44. That's terrible. But banks are rallying today, and people are jumping in and buying them, not realizing that the profitability of the banks that's measured by yield curve is getting much worse. And in fact, we saw it drop, again, like I said today. Do you realize to get to the point where you feel safe investing in bank stocks, to be safe to buy bank stocks, invest in, hold them, you want to make sure that we're at 150 plus. Okay, the yield curve's at 150 plus. We're at minus 44. Do the math. That means we have to go up 200 points to get to that 150. So that should give you the perception of what's going on, that these banks are in deep trouble. But you wouldn't know it if you're listening to the jibber jabbers. But when you do the math and you look at the yield curve, it's telling you that, hey, we got to be at 150. I'll buy the bank stocks. Now, we bought some bank stocks, okay, but we're doing just short-term swing trades, and we're doing pretty well with them. And we're waiting now for these banks to short again, to collapse, okay? But we did the swing trade on the way up, and glad we did, because when the yields came down again yesterday, because the institutions bought bonds, the yields went down for the wrong reasons, because they're in there buying them. I wish they weren't buying them. I wish they were going down for the right reason, but they're not. So again, if you're looking to trade these bank stocks, you got to be very, very careful. We're not telling you not to trade them, but you got to be very, very careful. Also, the important thing is, of course, IWM, the small mid-cap stocks, because the big institutions who drive this whole market, when they get upset, they don't feel comfortable. The first thing they do is dump all their small and mid caps, symbol IWM. And so IWM is so important to watch because if IWM starts rolling over, starts turning red, but the S&P doesn't, and the Nasdaq doesn't, stays green, it's telling you, uh-oh, get ready to short the small mid-cap stocks. Stop buying them. If you understand these things, you'll be a great trader. But Wall Street doesn't want you to understand these things. That's why they never talk about it. So I hope I helped you a little bit. So be careful. The bond yields are down for the wrong reason, and people are in there buying the same 12 stocks that make up 70% of the S&P profit. They're back and buying them again. They don't realize what's going on. All right, join my gang, philsgang.com. See you on the charts.